Hi, this week I want to talk a little about taxation, the effects of taxation on supply and demand, how taxation affects markets, and we'll look at some examples of taxes and government revenue, what revenue governments raise, and where they spend that. So the first thing I want to start with is taxation's effect on markets and supply and demand. So for that, I'm going to go to our whiteboard, and I want to draw out our basic supply and demand graph with price and quantity, where we might have a certain level of supply, a certain level of demand, and an equilibrium point here in the middle, where these meet at a certain quantity, Q1, and at a certain price, P1. And I want to talk about what's going to happen when we put a tax on this good in question. So whatever this good, this supply and demand is, we're going to go ahead and put a tax on that good. It could be a sales tax, an excise tax, a usage tax, what have you, but we're going to put a tax on that good. Now, just putting a tax on the good won't change the overall demand. It won't change demand for the good. People will want it just as much. However, having the tax on it is going to make suppliers less likely to offer it, and it's going to raise the price. We know that adding a tax to this good will raise the price. So we'll say it raises the price up here to a point at P2, and we can go out to where that hits our demand schedule here. And what we would imagine is that supply would probably decrease because of the tax. Providers would be less likely to want to provide this taxed good to people. So what we see here is that the price has gone up and the quantity of that good supplied in the market has gone down. And we can look at the revenue that would be generated from this tax. Because we know that this many people are buying it, we know that this area here in these boxes is the revenue raised from this tax. That's the revenue that's raised from putting the tax on this good. This amount of revenue at the top will be raised from consumers buying this product and paying the tax on it, but the higher rate will also affect producers. And this bit on the bottom shows us if we take this rectangle, we can multiply this out. Of course, the formula for an area of a rectangle is the length times the height. So the change in price overall here times this quantity 1 will give us the revenue from this tax. Part of that tax will be borne by consumers, and part of that tax will be borne by producers, the people who do the tax, who make the good in question here. So the tax falls upon both people who are paying it and the people who are producing this, which leaves us this area here, which was a part of our consumer and producer surplus and is now not occurring. This area here is now trade that doesn't occur because of this tax. This is trade at this quantity and price that would have occurred at the old level before the tax. And in economics, we call this a dead weight loss. This is trade that having this tax on the good causes not to occur because the tax causes a higher price on the good. Suppliers want to supply it more now that it's been taxed and it's more expensive, and we've moved to a different point up here on our demand structure because that price has risen. Consumers and producers alike will pay the revenue burden of this tax, but this area here is trade that would have occurred. We see that the quantity has gone down, less good is being sold. So that is a deadweight loss. Economists in all possible situations prefer to minimize these kinds of deadweight losses. We don't want to see these kinds of deadweight losses in markets because we know that trade builds wealth, trade creates value, and we look for ways to minimize this sort of deadweight loss so that more trade can occur. How much of this is going to fall on producers and how much of the tax is going to fall on consumers? What is the deadweight loss? As do a lot of things in economics, that is going to come down to the elasticities. The elasticities of these goods are going to determine the size of these boxes and how much revenue is raised from each one. And we can look at some differences between an elastic and an inelastic good. So I'll draw one here at the top with price and quantity. We'll put a relatively inelastic demand curve. And a relatively inelastic supply curve, and we'll draw in where our price and quantity are now. And we'll assume that our tax raises us to here. So we were at P1, we'll be at P2, and we were at Q1 to Q2, this kind of shift. And we can look and see here that consumers and producers are paying a relatively larger amount as our supply curve has shifted. But our deadweight loss in here has been relatively minimized. So the tax revenue has increased over our more elastic goods, and our deadweight loss has been limited. These inelastic goods are typically very big money makers. They're typically very good for raising taxes for governments because they're inelastic. We know that people are not very responsive to change. Consumers and producers, especially consumers, are not terribly responsive to changes. They're going to buy it anyway. What are some goods we've talked about that are relatively inelastic? People are going to buy it regardless of the price. Gasoline. People buy a certain amount of gas to get back and forth to work anyway, regardless of the price. Things like cigarettes, alcohol, gambling. People are going to smoke and drink even if it costs $1 or $2 more. Not surprisingly, we see very heavy tax rates on these things. We see high federal and state tax rates on gasoline, high taxes on cigarettes, high taxes on gambling, tax stamps on alcohol. We see that governments tend to like to place taxes on these things that are relatively inelastic. So let's take a look at some government revenue and taxation that is out there. Here's a spotlight of the federal government revenue in 2012. This hasn't changed very much. Here's where the government gets its revenue. About 46% from income taxes. Income taxes are a progressive tax where the tax rate goes up the more you make. This is where we talk about tax brackets. Payroll taxes are different from personal income taxes. So there's two major taxes that come out of your paycheck. Income tax and then payroll taxes. I know payroll is part of your income, so this gets confusing. Payroll taxes are earmarked to support Social Security, Medicare, and Medicaid. Income taxes themselves go to support overall government functions. So this is the federal government level in Washington, D.C., and we see that there's a few other places that they get money. Income taxes from corporations, duties, excise taxes. But notice that they're very small. The bulk of the federal government's money comes from those two taxes that come out of your paycheck, the income tax and the payroll tax to support Social Security, Medicare, and Medicaid. State and local governments in your state capital and your city get their money from very different sources. First of all, the largest source is transfers from the federal government who give them grants to provide certain services. State taxes largely rely on sales and excise taxes. 17.6% of state income largely comes from sales taxes. So the 4, 5, 6% that you pay in sales tax that you see on your receipt goes to your state, not the federal government. The state gets property taxes for the state and the county and city that you live in. They get some from income taxes, some corporate, some from user charges. This is, say, bridge tolls and road tolls and things that we're charging people to do. But this is where our federal, state, and local governments get their revenue from. So let's look real quick at who pays for what. Who does what with the money? Where do they get their money? And where do they spend it? The federal government largely gets their money, as we just saw, from income taxes, the payroll taxes, and corporate taxes. What do they spend it on? The largest expense that the federal government has by far is Social Security. After that, it's Medicare. Medicare is the system of health insurance for those over 65. The federal government pays for our national debt our national defense in the form of our military, the branches of our military, and they're paying interest on previous debt, on bonds that they've sold in the past to finance government spending. We have to keep the interest on that current. So that's our federal government. Our state government, as we saw, gets money from transfers from the federal government, sales tax, income tax, property tax. State government's largest expense is K through 12 education. This is where this is paid for at the state level. K through 12 education is your state's largest expense item. Other large expense items for your state include Medicaid. Medicaid is the government-run system of health insurance for those of low income, and a lot of kids are on Medicaid systems. Kids are easier to qualify for Medicaid than adults. So Medicare is for the old, those 65 and up. Medicaid is for those with low income, and it's largely run at the state level. States build most of the roads and transportation infrastructure. States fund your state colleges and universities, and they run prisons and law enforcement. So that leaves our local city and county governments. What our local city and county governments largely spend much of their money on is police, fire, and EMT services. After that, it's basic city services that your city offers and the cost of government itself. So that's where everyone's money comes from and who pays for what. Here's an example of the Commonwealth of Kentucky, all spending in the Commonwealth of Kentucky. Note that about a third of this spending in the 2018 to 2020 biennium is Medicaid. About 20% is post-secondary education. That's our colleges and universities. And about 15% is on K through 12 education. So of about $80 billion that the Commonwealth of Kentucky spends, here's largely where they spend it. And when we just look at the general fund, the overall general fund, taking out things that are necessary and mandated spending, almost half of that is on K through 12 education. So these are the big items that your states spend money on. Here's the city of Louisville. Here's Metro Louisville's revenue sources. And if you note, almost 60% of Louisville's money comes in through occupational taxes. This is a income tax that the city of Louisville levies on people who work here within the state. Another 25% comes from property taxes, from people who own property in Metro Louisville. And notice that everything else is a relatively small amount. So here's what Metro Louisville then spends that money on that they get. 52.7% is on public safety. This is police, fire, EMT services. It is the largest single item in the Louisville budget. This is for fiscal year 2018 and 2019. Community building, which is largely grants and donations to nonprofits who do services in the community, is another. Public services and central services itself, operating government, is another 15%. So that's a little bit on taxation and how taxes affect markets, how taxes change the supply and demand in a market and create a deadweight loss of trade that doesn't occur. We've also looked at some various taxes that the federal, state, and local governments levy and what they collect from them. There's a lot more into it in this week's reading, so I'll leave that to you, and thank you very much for watching.